On Wall Street, there are increasing cries for a recession, but for many of the households and companies that make up the global economy, the downturn has already begun. A US recession, according to the Federal Reserve Chair Jerome Powell, is not inescapable, but it's possible. At the end of 2022, Morgan Stanley economists predict a little recession in the Eurozone. Make sure to stay tuned until the end to find out more. Hey guys, welcome back to Economy Expert. Today in this video, we'll be discussing how a market meltdown or a recession will be caused by the labor shortages. But before we head over to the topic, make sure that you subscribe to our channel Economy Expert for more such content on economy. That said, let's take a closer look. US consumer prices increased by 7.5% in the past year, which is the highest rate in almost 40 years. Even worse, there are no signs of a slowdown in inflation. By hiking interest rates to combat inflation, the Federal Reserve typically slows the economy by lowering consumer demand for goods and services. The rate at which it rises should ideally be adequate to reduce inflation without triggering a recession. The Fed's inability to accurately regulate the pace of economic growth is the issue though. So, with the Fed set to hike rates next month, the question is, can the Fed do so without starting a recession, unless the war in Europe has a significant negative impact on the US economy? While a recession is unlikely to occur this year, it's more likely to occur the following year for a variety of reasons. First, the impact of an interest rate increase on the economy often takes time to materialize. According to some estimates, the impact of monetary policy doesn't reach its height until 1 to 2 years. Although the Fed is expected to begin raising rates in March, most of these increases are anticipated to take place in the second half of this year. Accordingly, 2023's negative economic effects will be significantly more severe than 2022's. Second, the sector of in-person services, which was severely impacted by the pandemic, is probably going to keep expanding quickly until 2022. Even though the dread of the pandemic is subsiding, the economy will develop strongly. Spending on items like restaurants, hotels, entertainment, public transit, hair salons, gyms, and many other consumption categories may not entirely return in 2022. That may sound like wonderful news, but by the beginning of 2023, the majority of the benefits of the recovery of in-person services will start to fade. By then, spending on these services will have returned to normal, just as increased interest rates begin to have a significant impact. Furthermore, the Burning Glass Institute predicts that the demand for workers will increase by around 4 million during 2022 as a result of a significant rebound in in-person services this year. By early 2023, the unemployment rate should be below 3%, down from its current level of 4%. Due to the low unemployment rate, wage pressures will persist and continue to fuel inflation. The Federal Reserve might discover in the second half of 2022 that inflation has not significantly decreased despite its early interest rate hikes. The Fed's hard-earned reputation for successfully controlling inflation will decline. It may increase interest rates more quickly than anticipated in 2023, significantly slowing economic growth as pressure to control inflation mounts. The labor scarcity won't go away with the epidemic, rather, it will just become the new normal. The US labor supply has been drastically reduced as a result of pandemic-related factors, such as the decline of immigration, early retirements, and lower labor force participation among those who are working age. The US population of working age began to decline in 2020, for instance, as a result of longer-term causes including the baby boomer generation's aging and retirement. In addition, before the pandemic, the labor force participation rate for women stopped increasing while it continued to fall for males and young adults. Furthermore, on Friday, August 5th at 8:30 a.m., the July non-farm payrolls report is scheduled for release. The report is released ahead of Wednesday, August 10th's release of the Consumer Price Index reading for July. The two reports taken together will provide a critical picture of the US economy, which has officially entered a recession following the second straight quarter of negative GDP growth. Here is some news from Insider that surfaced on the web. According to some experts, the biggest threat to the economy is joblessness, not inflation. While Fed Chair Jerome Powell has frequently cited the robust labor market as evidence that the economy can withstand higher interest rates, the central bank is treading carefully in its fight against inflation. Numerous Wall Street analysts believe that there will soon be a recession. Even as concerns about an impending recession grow, Americans continue to leave their jobs. According to the Bureau of Labor Statistics, 4.2 million workers left their jobs in June. 6.4 million Americans were employed in June, while the layoff rate remained low at 0.9%, indicating that hiring wasn't slowing down at the same time. This indicates that despite the fact that some businesses are experiencing layoffs and a halt in hiring, most employees aren't concerned about quitting their employment. The labor market may be showing some signs of cooling, but there are still plenty of employment possibilities available, according to Nick Bunker, Director of Economic Research at Indeed Hiring Lab, in an interview with Insider. Compared to recently, they have more negotiating leverage. From May to June, a few businesses experienced no change or just minor changes in their quit rates. Manufacturing and the mining and logging industries experienced no change in their quit rates in June. The construction industry's quit rate decreased by 0.7 percentage points to 2.3%. Leisure and hospitality, the industry with the highest quit rate among major industries, saw its rate fall 0.1 percentage point to 5.4%. According to Bunker, there is still a strong desire to hire people. Despite the same leave rate from May to June, there were 605,000 fewer job opportunities in June than there were in May, 11.3 million compared to 10.7 million. According to Bunker, this can indicate a minor slowdown in hiring and that the peak in hiring plans has gone. Most firms are certainly looking around and they're either staffed up to a certain level or maybe they're starting to reassess some of their short-term recruiting plans, so they're pulling back a little bit with job opportunities, he added. However, it's crucial to take into account the backdrop of that decline in employment vacancies. Though lower than in recent months, it's still significantly higher than pre-pandemic highs. They've descended the mountain a little, but, as Bunker put it, they still are very close to the top. The same is true for businesses that are laying off employees. Both the real estate and technology industries, which include computer companies, saw a modest increase in layoffs. They are still low, though, in comparison to pre-pandemic levels, as Bunker points out. He affirmed, "I believe, sure, the tendency is sort of a ramp-up in layoffs. However, if the rate of employee layoffs in those sectors is the same as it was before the epidemic, the labor market is still in rather good shape. It's not a huge, alarming trend, to put it briefly. That holds true for employees as well, who don't seem overly anxious about a possible downturn. We wouldn't observe high quit rates, according to Bunker, if people believed that a recession was impending or if they were unable to obtain new employment because employers believed the same." Additionally, the Fed tripled the magnitude of its usual rate hikes by increasing rates by 0.75 percentage points at both its meetings in June and July. Additionally, Fed officials have made it clear that they want to maintain the target until 2023. Participants in economic estimates made public after the central bank's policy meeting in June predicted that the federal funds rate would hit 3.4% by the end of 2022. The Fed will raise interest rates by a total of 4 quarter-point increments during its final 3 meetings this year, up from the current range of 2.25 to 2.5%. The benchmark is then anticipated to reach 3.8% by the end of 2023, before falling back to 3.4% in 2024, according to members. That suggests that there will be some relaxation during the year, but not enough to significantly lower interest rates. Powell advised taking a grain of salt to any predictions of rates for the following year. "I think there's a lot more ambiguity now about the way forward than there used to be, and normally it's fairly high. Simply put, there is no assurance that investors will receive the reduced rates they anticipate. But as concerns about a recession grow and indicators of a slowing economy mount, the likelihood of a Fed reversal is increasing." What do you guys think? Will the US be able to avoid a recession? Let us know your thoughts in the comment section. And that's all for today. Thank you for watching. If you enjoyed it, please like, share and subscribe to our channel Economy Expert for more such amazing content. See you in the next video.